Welcome to Commercial Real Estate Now. I'm your host, Karly Iacono. Today, I am so pleased to be joined by Matt Pizzolato, Senior Vice President in CBRE's Debt and Structured Finance Group. Matt, welcome to the show. How are you?
I'm doing well. Thank you for having me, Karly.
My pleasure. Really glad you could come join us today. You know, there was a time when every day it felt like we were talking about interest rates and debt and where the capital markets were going. And then things got quiet. But you know what? It's time. It's time to bring that back and get an update on where we are on debt and finance. So before we jump in, why don't you take just a moment and tell the audience a little bit about yourself and your team and the types of deals that you work on?
Yes. So I've been doing this for a little over a decade. Our team across both New Jersey and New York, we're about 8 people. Last year, our team did a little over $3 billion in volume. When you think about us in terms of the deal types, mostly multifamily, industrial, as well as retail and office, and anywhere from 10 million to upwards of 300 to 400 million in deal size.
It's a big range. 10 to 400 million?
Yes.
I like it.
Yes.
My business is kind of like that as well. It's interesting, isn't it? And,
yes.
And do you span the private to institutional client space, or
Very
do you
much
focus
so.
on more one than the other?
No, I always thought of us as more generalists, right? And, you know, if you think about who our clients are, most of our clients more in the private sector, but institutional quality, right? And they may have institutional partners. But then we're also partnering up with colleagues across the country as well. 80% of our business maybe is here in the Northeast, the rest going up and down the East Coast and out to the Midwest.
Okay, nice. Good background. So if you were to describe the lending environment in one word right now, what would it be?
Fluid.
Fluid?
Yes.
Okay, tell me why.
You know, if you kind of look back, right, when rates were starting to jump back in 2023, as the Fed was starting to raise rates, I think that's where you started to see kind of the halt in the market. Over the past 18 to 24 months, with the banks really starting to come back into the market, that brought a lot of liquidity back in, right? And they've kind of led the front from both construction financing on the perm side, and then also behind the scenes with some of the debt funds, not to get too technical, they back leverage them, right? So with the banks now being more competitive, it's forced other capital sources in order to put the money out to stretch either on leverage, bring pricing in, figure out ways to be more competitive to put the capital out on the debt side. You know, I think the best way to describe it is there's a lot more debt capital chasing too few deals.
Interesting. And is that because banks were on the sidelines for so long that they just absolutely have to get capital out, or are the deals starting to make more sense so they have the confidence to start lending at greater levels?
A few things, I guess kind of 2 pieces there I'll hit on is first, obviously with how quick rates ran up, there's some banks that had to work through some issues on the balance sheet. And then with the new administration coming in last year, you know, one of the things they ran on was less regulation. So that also helped on the bank front as well. So you kind of saw that in the beginning or end of 24, beginning of 25, where the banks really started to come back in the market. And with that, you saw a lot more competition. LTVs started to move back up. It helped that the Fed was cutting rates at the end of 24 and end of 25. So that naturally brought the interest rate environment down a little bit.
And are most of the clients that you're talking to waiting for rates to drop still, or is that over? I mean, from my perspective, I feel a sense of acceptance of where we are. Everyone doesn't love it, but it's just an understanding that we have to make deals pencil with where rates are and we can't wait any longer. But are you still hearing clients say, should we test the market in 6 months? Will it be better?
There's always cases. So what I would say it's deal by deal, case by case. But I think we're hearing a lot less clients saying, you know what, we're going to push this off for a year. Because at the end of the day, we've quote unquote kicked the can long enough. So whether it's a looming maturity, approvals that may be expiring soon, they need to put a shovel in the ground. There's enough capital out there. Whether again, it's banks, it's life insurance companies, it's the private capital world as well, to find a debt solution for whatever the need may be.
Let's go back to the groups of lenders for a minute. You mentioned that debt funds were coming in and increasing competition. How do they outperform, or when do they outperform banks? What levers do they have that banks don't, and where does one shine over the other?
I would say the 2 big differentiators between, let's call it debt funds and banks, are banks, they're typically, it's called construction for now. Banks are typically 65 to 70% of costs. So that means debt funds are going to have to compete in the plus or minus 75% of costs. So pushing leverage a little bit. Also, debt funds are non-recourse. Banks require typically some level of recourse. Depending on who the sponsor is and who the bank is, it could be minimal, 15, 20%. Some banks may require full recourse on construction as well. So those are usually the two hot buttons. The debt funds, in exchange for going a little higher in the stack, capital stack, they're going to get paid a little bit more. So if a bank's cost of capital, or I should say their cost of capital, what they're going to charge the borrower is SOFR 200 to 2.25. A debt fund on that same deal, up to 75+% of cost, they may be SOFR 3.25 to 3.5.
You read my mind, because the next question that I wanted to ask you was on spreads.
Yep.
So how do spreads look today compared to 12 months ago, 24 months ago? Have they come in? Have they kind of stayed flat? And what's that look like across different borrower profiles, lender profiles?
I would say, just making a general statement across the board, we've seen spreads, not just year to date, but let's say over the past 12 to 18 months, we've seen spreads come in significantly. So I think starting from, talking construction, right? We've seen spreads year to date alone, probably anywhere from 15 to 25 plus basis points. I think a perfect example of that is a deal we're working on in Morris County. It's about 100,000 square foot spec industrial development. We're originally out in the market last fall. There were some delays with some of the approvals, so we put it on pause. We have a bank that's quoting today at SOFR plus 255. That same bank was at SOFR 300 in the fall, right?
Wow.
So
that's a material difference.
Yes.
Interesting. And are most of your clients looking at the all-in rate, or are they talking and watching spreads?
I mean, at the end of the day, right, it's the same in some sense, but spreads are going to drive where your all-in rate is. Obviously, SOFR's been pretty tied to the Fed funds rate and what the Fed's been doing with cutting rates. However, the treasuries, so, fixed rates, a little less so, right? And I think my personal opinion there is that's been tied a little bit more to inflation expectations. So, last year, the big talk was tariffs, right? And we see what that did to the treasury market. Right now, we're obviously seeing the Middle East conflict, right? So that really started end of February. So beginning of January to end of February, you actually saw treasury rates were going down. Since the end of February, we're up, whether it's the 5, 7, or 10 year, we're up anywhere from 30 to 40 plus basis points on benchmark rates.
That's significant.
Yes.
I think the inflation numbers came out this morning, if I'm not mistaken. Wasn't it like 3.86?
Yep.
Going off memory?
Yep.
Higher than anyone expected. Do you think that's going to put additional pressure on the Fed, or was that kind of baked into their strategy already?
I think obviously we're going to be going through a change in, the Fed shortly. I think there were certainly some expectations that inflation was going to come in a little hot. A lot of that, in reading it this morning, was driven by just higher fuel prices with what's going on overseas. So again, there's some expectation there that was already kind of baked in. You've seen kind of just immediately post the release there, yields moved up a little bit. We'll see how that plays out. At the end of the day, right, this is kind of a point in time. And so, is this, more of a short-term blip, or is this going to be a little bit more longer term? And, again, we're 60 plus days into this. If we're still talking about this middle to end of summer, I think there could be an issue there.
I think everyone's trying to predict that, right? And that's the trickiest thing. Is this just a political strategy that's short term, or do we have long-term conflict and therefore pressure on oil prices, inflation, et cetera? And it's really hard to predict politics.
Yeah, I try and stay out of politics.
Yeah.
And I don't want to predict that. Also don't want to predict the rate market. We can only advise our clients on what we think at that point in time. And, our advice is typically, if the rate works, take it. Yeah. Right? Because, I don't have a crystal ball that works. I don't know someone that does.
Everyone's broken.
Everyone's broken. Maybe it's right at some point. But, I think thankfully, right, and the one thing that's really been helping us and helping the markets is fundamentals at the property level have been and remain strong, right? So I think if you look at the broader economy across the country, we're not seeing necessarily any cracks there, right? So multifamily rents continue to hold up. You'll see some concessions through lease up, but there isn't a general market where there's some weakness. And then on the industrial front, obviously those fundamentals have really started to pick up. From a leasing standpoint, that's really turned around. And you've seen some of the larger boxes start to get leased up there.
And that's really real estate at its core, right? The fundamentals instead of financial engineering, which we had for so many years. So in some ways, I would argue it's become a much simpler business because it's now tied to true performance and fundamentals, not future expectations, right?
Correct.
Are you seeing lenders then just really get more comfortable? Let's take all the inflation and the political uncertainty out of the picture for a minute. Is the lending market more liquid, because that was your word of the year, because of fundamental strength? Or do you think, again, it's just competition and everyone's trying to put money out? So do you think it's really security, or is it fear of missing out?
What I would kind of put it to is there's just a lot more capital both raised around and centered around the debt side, right? Today, more so than over the last, 3, 4, 5 years ago, there's more life insurance companies, for instance, that are running around with separate accounts, right? And it used to be, call it pre-COVID, and even before then, it was really just these life insurance companies were kind of your core lenders, right? Focused on lower leverage, stabilized products. Now they're doing stretch senior construction loans. They're doing value add bridge loans. They could do a core floating rate. And so they're trying to be a one-stop shop for, our clients where, they could be your construction lender, they could be your permanent lender as well. And obviously there's a lot of life insurance companies on the equity side as well.
So what product are you able to offer clients now that maybe you weren't a few years ago? It sounds like there's a lot of new structures floating around.
Yeah, I would say the one that we've been most active in, especially on the multifamily front, for instance, is the construction loan takeout, where it's kind of more of a stretch senior. So going up to 65 to 70% of value, and stretching down to a 7.5 to 7.75 debt yield. There's not a lot of core lenders out there that get there, but there are a few life insurance companies and other lenders out there that could price in the upper 100s on a 5-year deal, full term IO, and that allows the borrower to not just pay off their construction loan, but also repatriate some equity. And then kind of lets them stabilize and season the property over the next 3 to 5 years, depending on the loan term.
So if you don't talk debt every day, that kind of sounded like Greek. So
yes.
let's break that down just a little more. That was a stretch senior scenario. How does that differ from a traditional scenario?
So
what piece of that was the stretch part?
A typical bank and a typical life insurance company, for instance, they'll probably average out to, let's call it, plus or minus 60% of value.
Okay.
And that may shake
value.
out.
Yep.
Correct. And that'll shake out to maybe it's an 8.5 debt yield. To stretch below that or higher on leverage, right? There are certain lenders out there that will get paid for it in going up higher in the capital stack. In addition, they're going to, get it pricing at 185 to 200 over the treasury.
Got it. Okay, so you're playing with the overall proceeds relative to the value of the property.
Correct.
Along with spreads and term, et cetera. You've got a few different levers there.
Exactly.
And that's how lenders are competing for the business, right?
Exactly, because there's groups out there with certain life insurance companies that have minimum yields that they're trying to solve for. And, there's life insurance companies that could price down to, 110 to 120 over the treasury. They're not pushing up to 65% leverage. They want to be at 50 or maybe 55% leverage.
So they're going to price more competitively, but in return, they want less risk, which means typically from a lender side, less leverage on a property.
Correct.
It's all risk reward, isn't it? It's all the same, no matter what side of the business you're on, risk reward.
Correct. And again, just going back to the point and hitting on it again, there's a lot more solutions for borrowers out there today, probably more so than I've seen in my career. And it's giving borrowers the option to put the shovel in the ground on the development deal that 2 or 3 years ago there wasn't a capital solution for, or a solution to a borrower, either construction loan takeout or permanent financing, to maybe push proceeds a little bit.
What's one of the most creative financing structures that you've put in place for a client? Do you have a good deal story or a good example of something that really took some work to get done?
Yeah, so there's a deal in downtown Jersey City. We closed it right around the holidays last year. It's about 50 to 60 units with about 15,000 square feet of ground floor commercial right at one of the pass stations.
Okay.
This was a borrower who built in Jersey City before, and this deal specifically was about a $40 million capitalization. And we were able to get him $34.5 million between a senior loan and a mezzanine loan. Right. So you talk about like stretch financing. Right. That was up to about 85% of cost, but that was really marking the land up. So that's the other way where we could be a little bit creative. You know, he had a basis from 2015 land basis. So that's obviously appreciated significantly, especially with the approvals he was able to get. And so that 85% of cost is really 95+% of actual costs.
Wow.
Right. So
interesting. Yeah.
We were marking the land up and his budget was 40 million. His cash basis was probably 36.
Wow. And is that a good partnership with appraisers? Like how do they fit into this overall puzzle?
Yeah, I mean, how we always typically run our process is before we even go to market, especially on development deals, we're talking with multiple appraisers to make sure that we're not going to have a hiccup down the road on where we're marking land or where we're saying stabilized value is or rents are. So we vet that up front. But yes, it's a good relationship with appraisers. And also, you know, downtown Jersey City, you know, lived on the waterfront for almost 15 years. So a pretty good sense of what's going on there, where values are.
Nice. Let's switch gears for a minute and talk about loan assumptions. So in my world, in the single tenant net lease, we're starting to see CTL financing and zero cash flow deals where you assume the loan come back, right? The numbers hadn't made sense for a few years. And obviously that's a very niche part of the market, but we're excited that the loan assumptions in that particular deal structure are coming back. In more traditional financing, not necessarily a zero, are you seeing assumptions have value? Is there a period where rates were lower that's there's still term left on any of those loans that you're seeing assumptions be I guess a thing again, or have we really used up that term and it's just
no, it's situational. I mean, back in 21, 22 during the zero interest rate policy era, there were a lot of deals we put on where sub 3% interest rates, full term IO, 10-year deals. We actually closed a 5-year bank loan in April of 20 on a single tenant office building in Morris County at 1.78%.
That's crazy.
Yeah.
You say that out loud today, it's like an office building, 1.8%.
Yeah. I don't know how it's doing now, but
right. Hopefully they don't need to refi in the near term.
Correct. It was, but going back to your question on loan assumptions, again, situational. I would say the one thing there is, you look back at the sub 3% interest rates back in 21, we're almost 5 years into it, right? Fundamentals, going back to what we were saying before, fundamentals have continued to be relatively positive, especially on the multifamily front. And so that 65% loan back then may be closer to 50 to 55% LTV today, even though cap rates have obviously adjusted. Rents have significantly moved up. So is a 50 to 55% loan really that attractive? That means the borrower needs to come to the table with, call it 40 to 50% cash. There's ways of putting a supplemental loan on there today. It's just, again, situational, deal by deal.
And what kind of lenders would take that second position? Because it's obviously a different risk profile.
Obviously the agencies, Freddie, Fannie,
Okay.
You can do a supplemental loan on the multifamily side. Life insurance companies, they could write a B note. But there's always you also have to underwrite the new borrower, right? And they still have to get approved.
Right.
There's an assumption fee. So it's again, very situationally nuanced there.
What kind of premium would you see on a B note versus a primary mortgage? Is there a spread, for being in the secondary position? I'm sure it's case by case, but overall.
It's case by case. I think rule of thumb is you're probably in the mid 100s to 200 bips wider on spread
That's interesting.
than you're, if you were go out to market today.
Okay. Good data.
So sometimes it's not always as accretive as you may think.
Right. Gets expensive fast.
Yes.
That much financing. What would you do if you were a borrower with a loan coming due? I'm sure the answer is start early and call you quick. But aside from basic advice like that, how would you approach the debt market and how much time do you really need before your loan maturity to start the refi or maybe sale? But let's stick with the refi process.
Yeah, I mean, listen, today things are always taking a little bit longer. I would say the quickest process that we've been, up and down on, from literally getting the engagement signed, materials put together, out to market, closing, it's probably a 3 to 4 month process at minimum. And I'd arguably say probably closer to 5 to 6 months from truly start to finish. So really getting out in front of, giving yourself time in the market versus being too rushed, right? Because sometimes you'll lose lenders' interest if, you call them on a Monday and say you need feedback by, early the following week. So I think being a little bit more thoughtful about that.
Can you be too far out to where lenders don't want to talk to you because there's
we're probably not going to go out to market today if we don't want to close until December.
Okay.
But if we want to close in the fall, I would say let's start putting the materials together and try and get out in June. Because the other thing you got to think about too is, we're going to head into the summer lull. Granted, I've never seen a true lull in the summer. It's just
like, when does that actually happen? Maybe August. I'll give you that.
Yeah.
2 weeks in August.
People are always traveling, right?
Yeah.
So to get people focused and think about, once you get the quote, they have to go to an investment committee to get things approved. So again, you have 1 week, 2 week, 3 weeks that go by, and before you know it, you're already 2 months into the process.
Right. Have you seen the opposite side of that where lenders are extending, let's say a borrower runs out of time, right? They don't follow your guidelines and they can't get their refi done. How flexible have lenders been in short-term extensions?
Very. I mean, we're in the middle one right now. We're closing on a land loan up in White Plains today. Thank you.
Almost, right?
Today, tomorrow, maybe. Goes back to what I was saying. Things take a little bit longer.
Yeah.
And with that, the loan, they had to extend it, right? Because there were some things that came up at part of the closing that we had to push back out our closing timeline. And so, with that, the lender was able to extend for another 2 months. Obviously, there's a minimal cost associated with that, but they're flexible. Lenders don't want to take these deals back.
Right. What about the other side of the spectrum where a deal is not performing and, it's either foreclosure or maybe a loan workout? Are you seeing a lot of distress? And if so, how are lenders viewing that? Are they taking them back or are they still kicking the can down the road?
Again, very situationally up here in the Northeast. I think a lot of focus has been down kind of in the Sun Belt Southeast, especially on the multifamily front. Where you saw a lot of shovels in the ground. There's a huge pipeline of inventory and development that came through, from the Carolinas through Texas. And, you saw rents kind of move the other way because of how many units were delivered. I think every developer will tell you how tough it is to get approvals here. But because of that, there's been a pretty muted development pipeline, let's say, on the multifamily front. Obviously, some of the Hudson waterfront areas have seen a pretty large pipeline, but they've absorbed those units, right? And, as a current renter and a former renter of the Hudson waterfront, I could personally attest to that rents have not gone the other way.
Yeah. I don't think rents really ever go the other way, at least in the Northeast.
Not up here. They have
driven, right?
Yeah,
supply
correct.
Demand, yeah.
So, again, down in the Sun Belt markets, you have seen some distress and where lenders have stepped in and taken deals back. I think it's more one-off cases up here. We haven't seen a general kind of movement of lenders, taking stuff back.
I think a few years ago, there was just a mass amount of capital for distressed funds being put together. I don't know if that ever went anywhere. That's not my space, but that was all the conversation for a good 2 years, right? When all these loans come due, there's going to be massive distress and foreclosure, and we're ready to sweep in and buy all these properties at a massive discount. And I just haven't seen those sales. Maybe in office. I don't know. Again, not my space, but have you seen that play out, even if it was a few years ago? Did that ever come true?
No. Again, not up here.
Yeah.
On the office front, you've seen whether it's some conversions or some basis resets. So we have seen some of that. I won't talk deal specifics, but again, there isn't like a general theme, again, in our region where, there was a ton of distress and you saw these, distressed funds kind of step in at a steep basis.
They were ready, though. I think they
were ready, and I'm sure they're still there.
Big returns.
There's a couple examples on the office side where you've seen people step in by the debt and come into ownership. But again, you can't say, there was a dozen or so deals, examples like that.
And that's not a lot. So It's amazing how resilient the industry is in the face of rapid change, especially financial metrics changing overnight.
Yeah, you've seen the fundamentals kind of bounce back too. So I think that's what's kind of helped put a floor on some of that distress. right? And again, I keep going back to the Southeast, but that's where, completely different supply demand dynamics. I mean, yeah, they saw the population growth, but again, there was, so many units on the multifamily front that were brought to market down there,
Right.
that you did see kind of a reset in rents, and property values obviously decreased because cost of capital went up, which means cap rates go down.
Right. Is industrial still the darling, or would you say it's multifamily from a lender perspective? Or it could be retail. We're allowed to say retail is the darling. I'm waiting for that day, but
yeah, I was going to say retail. Now, retail comes in a lot of different forms,
yes,
right?
That's
So
very true.
grocery anchored, neighborhood strip, big box, all the malls. So you can't just say retail.
True.
Obviously, grocery anchored retail is, I guess, the darling at the ball. Multifamily is still pretty hot. Industrial is obviously coming back too, just given where the fundamentals have been. And then, the northern New Jersey industrial markets, depending on who you ask, number 1 or 2 industrial market in the country, given our access to the port and population.
1 or 2. I think I know who 2 might be if we're saying we're 1. So
yeah.
I'm sure that would be a fun debate.
Yeah.
Among the coasts.
But yeah, I would say it's kind of a mix, right? And on the multifamily front, it's interesting because, on the refinance front with stabilized product, whenever we go to market, everyone's first question, well, where are the agencies, right? And not every deal is made for the agencies there, especially on the taking out a construction loan. Maybe there's still some concessions that, a balance sheet lender may be able to underwrite through, whereas the agencies may not be able to get as aggressive. So that's where we've seen the agencies be a little less competitive and more either banks or life insurance companies step up there. On the industrial front, again, is it single tenant or multi-tenant industrial class A with an institutional sponsor? You'll have, a dozen plus quotes coming in from the life insurance companies and banks there. I guess the one thing I didn't mention earlier is while there's a ton of debt capital chasing deals, they are still disciplined, right? So if you have a class A industrial building in a tertiary market with a not tier 1 type borrower, I think it's going to be very tough to try and place that.
How about lease term? How much does that play into lender interest?
Deal by deal, right? Because it's all about how you spin the story. So if you have 3 to 4 years left in the lease term, is the current market below or current rent below market?
Right.
Are you in a tight supply, infill market, or again, are you out in, the middle of? I don't want to say Pennsylvania because I don't want to talk.
Yeah, no negativity here.
Are you out in the middle of a tertiary market?
Right. Exactly.
Where there may not be as much demand. So again, it just goes back to how you spin the story. And again, as an advisor, right? I mean, that's really what we're doing. We're telling a story and trying to sell the story to the market.
Which is the lenders.
Correct.
Yeah. Interesting. Is there one thing that keeps you up at night that you see as a massive risk factor for the next year?
Not necessarily, right? And again, this goes back to what I was saying earlier, that the debt markets are extremely fluid. Obviously, they're liquid right now, but they're very fluid, right? And what I mean by that is there's more and more capital sources coming into the market today than there were 12, 24, 36 months ago. And that's giving us the option where, if lender A is backed out, right, and maybe they're not as competitive right now, I got lender B, C, and D to step in.
That's great.
In general, right, there's been some noise around the private credit market. Less so as it relates to real estate, more so as it relates to actually lending to private companies. I would say the one potential risk over the next 12 plus months, if there's some, if something were to happen, right, where, a lot of these private funds are lending to, let's say, a lot of these AI companies, right, and there's some contagion risk there. Going back to what I was mentioning earlier, banks back lever a lot of these funds, right? So if there's some risk where all of a sudden these loans start to go bad, then there's a rippling effect to some of the banks, right? And if the banks really start to pull back, then we're back to where we were 3 years ago, where lending activity is down.
So that could keep you up at night. I'm glad it doesn't, but
it could. Yeah.
It could.
Yeah.
I have heard that even just the scale of the AI investment, building a data center, takes so much equity out of the market in general that we could reach a point where that limits lending for other asset types because there's such a massive need.
There are. There's a lot of the infrastructure funds that can lend there. So
Right.
I haven't seen that spill over into having a conversation, for instance, with a debt fund and saying, we're too overexposed here because of data center lending, for instance.
Right.
But I would say that's probably the one. I don't want to say concern, but if there is a concern to have,
watch.
Yes,
that could impact the market. I
Correct.
think is fair. Yeah. What prediction and, wonderful closing thought do you have for us for the end of 26, second half of 26? Give us your prediction.
Scary to say. We're already almost at the end of May.
Yeah,
I guess we're in the
exactly.
middle of May right now. But my prediction, I think, again, markets will remain fluid and liquid, but similar to what we've seen in prior years. I think as we kind of head into the middle to back half of summer, you're going to see a little less liquidity in the markets as some lenders have kind of run through their allocations. And so maybe you do start to see some of the spread widening, right?
Oh, interesting. So not because of a change in public policy,
No,
not
just
because of a change in the underlying assets, just availability of capital for that particular lender pool could change the spreads as they can be more choosy, I guess.
Yeah, correct. So if a lender's had $1 billion to put out this year and come August 1st, they're through $800 to $900 million, maybe they don't need
aggressive.
Exactly.
Wow.
And so that's typically what we see in most years, right? Okay. And there's some lenders that wait till the back half of the year and maybe don't do as much in the first half, so they can get a little bit more premium, right? Assuming fundamentals haven't changed. So, advice to clients, right? If you're looking to close in December, again, maybe we're not hitting the launch button today, but let's start prepping some things, right? And maybe let's start to go out to market in July, August, so that we're not rushing in October.
That's great advice because I've never looked at the market that way. For us, the back half of the year is always the busiest as everyone tries to squeeze deals in before year end. But from a lender availability of funds and allocation perspective, that's very good advice. Really be prepared.
You could always slow a process down. It's very tough to speed it up. Again, so I like to get out in front of those things. And again, you have to work around people's travel schedules. The holidays that we hit, post Labor Day, right? So people start to disappear, and before you know it, it's Thanksgiving, and you had a month to close.
Well, I think overall your message was very positive, and it sounds like we've really hit a point of equilibrium where fundamentals are strong. There's capital available. I love the liquidity as the word of the year, and lenders are ready to put money out, and the assets support.
For the right deals, for the right sponsors.
We're not saying everything.
Yes.
Don't bring us bad deals, right?
I don't know if there's a bad deal. I'm sure there's some lender out there. But again, capital is discipline, but capital is also is a very fluid market right now. And we continue to remain optimistic. I think if you look both across our national pipeline, right, at CB and some of our competitors as well, I think we're up year over year, right? Or I know we're up year over year. I'm assuming our competitors are too, just knowing kind of where they finished and hearing some of my former colleagues and kind of what they're working on. So, I think it's a unique time in the market, but very optimistic about, where things will shape up this year.
Love it. It's always good to end on good news.
Yes.
So thank you so much for joining us and sharing your perspectives on the debt market. I think it was very valuable and I appreciate your time.
Well, thank you for having me, Karly.
To everyone listening, that was this episode of Commercial Real Estate Now. We're so happy you tuned in and look forward to seeing you again very soon. Have a great day, everyone.